everybody, it's Danielle Damianov with CMG Financial, and I am here today to talk about the all-in-one loan with Dave Herbst, who is, well, Dave, why don't you tell everybody a little bit about what your position is with the company?
Yeah, sure. Thanks for having me, Danielle. So I manage our all-in-one loan program. Of course, it's a proprietary loan program that CMG Financial engineered back in 2005. So it's not a new program. It certainly is somewhat new to learn about. I don't think a lot of Americans really know that it exists. I think they really need this product, of course, but they just don't know it exists yet. So I manage, our consumer education awareness effort, as well as you know, our internal education effort. To make this product, visible and make sure that people understand how it works so they can, make a better mortgage decision for themselves.
Yeah, I'm really excited to talk about the product because I honestly think it is one of the best products out there. And back in '05, when I guess, originated here, right? It was also called the Home Ownership Accelerator Program.
That's correct. Yeah, that's correct. Our original brand name for the product, the Home Ownership Accelerator. If you think about it, it's 9 syllables long. It's a pretty lengthy name for a mortgage product in the industry. But it of course the structure is exactly the same. We peeled off a second brand name for it right around 2010, the all-in-one loan, because number one, it's easier to remember. It's more reflective of really what the mortgage product is, how it's structured, and where it comes from. And coincidentally, we had actually licensed that previous brand name to one of our business partners, a large financial securities firm, a global firm. And they wanted to use that brand name, the Home Ownership Accelerator, as it related to their own clients and the service they applied to their clients. So same product, but yes, a lot of people do still recall and know it as the Home Ownership Accelerator. Great program.
Yeah, definitely. So why don't you tell us a little bit about the program and how it differs from a traditional mortgage?
It's very different. There's a lot of things to cover, but I'll sort of summarize it this way. I think that the best place to begin is really what it's used for. What it's used for, and what its intent is to make it easier for customers to reduce the total cost of the mortgage, right? So when we think about mortgages, I think that by default, most of us just kind of gravitate to interest rate and payment, right? That's kind of really the first things, and sometimes only the last things we really think of when we think about borrowing money and getting a mortgage. What's the interest rate? I guess what's my closing cost, and what's my payment going to look like? I think that what's often missed is analyzing how much you pay in total, right? There's the borrowed principal, and then there's the interest expense that you have to pay over time. And the reality is that the longer we stay in debt, any debt for that matter, mortgages, car loans, boat loans, doesn't matter. The longer we carry debt, the more expensive that debt becomes to us. So if people are interested in saving time and money, it should be a financial goal to shorten the life of that loan, shorten the life of their debt, right? Try to sunset it as quickly as possible. But mortgages make that very difficult because these are instruments that were developed during the Great Depression era. They're very rigid. You can only put money towards the mortgage. You can't take money out. Makes it very uncomfortable, potentially even unsafe to actually try to pay it down faster because your money is locked up for, permanently in the mortgage. So the all-in-one loan solves all of that by keeping money liquid and helping people pay down faster, comfortably without changing their budget. And again, the benefit there is to help them save money. Now that's money on their monthly payment. That's saving money annually. That's saving money in total. So it essentially reduces the total cost of the financing needed for real estate. The way that's accomplished, Danielle, is how it's structured. So it's we really engineered this after products that are available in other countries that are really mainstream in other countries, Canada, New Zealand, Australia, throughout Western Europe, where it involves 2 accounts bundled together. One is the home financing. And the home financing side of the all-in-one loan is powered by a first lien position, 30-year draw home equity line of credit. So it provides you access in and out of your mortgage for 30 years freely, 24/7 access. You can freely pay down your principal and take your money right back out that next moment or that next day or that next year over 30 years. And it's also linked with what's called a zero balance sweep checking account. So it's a personal checking account that comes with the mortgage and it's linked with it automatically. And this allows a customer to actually use their regular banking activity, their regular income, to drive down their mortgage balance faster. And then it does that without any budgetary change. So it's a slight shift in the way we think, but it doesn't require, any change in your lifestyle, nor any change in your expense level. So it's very practical today, the combination of borrowing and banking in one consolidated place to make your money go further for you.
Right. Yeah, no, and I think, first of all, it's phenomenal that you have a checking account combined with that first mortgage HELOC. One of the best things that I love about the product is being able to, number one, pay down that mortgage so much faster without changing a single thing that you do in your daily spending, as well as always having access to that line of credit, so that, once you do pay it down, you're able to tap back into it, whether you're looking to buy an investment property or, put more money into retirement, pay for your kids' school, go on vacation, whatever it is. It allows you that flexibility to tap into that equity, where with a traditional mortgage, the only way you can get your equity out is if you refinance. And we all know the cost that comes with refinancing. So definitely.
Or add a second lien right behind your first lien mortgage product, right? And now you're really kind of further at risk. Generally, second lien HELOCs are engineered to, exactly like you stated, allow access into equity dollars. And the way that they're used is people generally end up with more debt than they started with. Meanwhile, their first lien mortgage, a traditional mortgage product that's amortized and closed-ended, really impedes your progress with principal pay down, right? Most of the payment is structured to where you're paying interest primarily first, really for about the first half of the loan's term. In fact, you'll pay about 50% of the total interest due in the first 10 years. So it's in my view, it's a colossal waste, certainly a consumption of, valuable resources, your income that we all work hard for, going towards interest cost. As I like to kind of coach people to think differently, one of the things that I try to highlight is, when you borrow money, especially on a mortgage, you're going to pay interest cost. And if you're, as an example, if you're borrowing $500,000 and the amount of interest that's going to come with that loan is, let's just say $350,000, right? Over 30 years. Again, 50% of that cost is going to be paid for in the first 10 years alone. But if that's the total price tag of your mortgage, that's a lot of money that you've got to earn and pay the lender, right? If you could cut the total interest down by 50%, maybe instead of spending 350 grand and maybe only spending $150,000 in interest, how would that change your life? If you didn't have to pay that expense, you now have more of your own money left over for bigger and better financial needs. That's the beauty of this loan, is it creates opportunity just by using it.
So that brings me to a really good question, and a question that I'm hearing a lot lately is, interest rates are still historically low. And with this product, it is a 1-month adjustable. So if somebody can get into a low, 3.5%, 3.75% fully amortized 30-year fixed interest rate right now, why would it be more beneficial for them to go into the all-in-one, which is a little bit of a riskier product since it is a 1-month adjustable? And with rates on the rise, they could go up pretty high. So what would your, advice be to somebody posing that question?
Well, first, that ultimately, I think that every customer that is looking at this and really kind of kicking the tires has to ask themselves, what is a matter of more importance, the interest rate that comes with their loan or the amount of interest they pay on their loan, right? If we can establish that first, the answer to that first, and I think that your audience would agree that the real money you have to earn and spend on a debt, right, is more important than just literally the interest rate. So once we establish that, then I think the next thing to consider and ask is it possible to have an interest rate that's slightly higher? And by the way, the interest rate on the all-in-one loan is very competitive. It's not high. It tends to move with monetary policy set in the United States by our Fed. And that really, is aligned with, market 30-year fixed interest rates, so even though it can adjust, it not only can adjust upward here and there, but it also can adjust downward. It just goes through those cycles over time. the biggest benefit of the all-in-one loan is the application of the money you already have in your possession. Most people will earn more money in just 5 years than they owe on their mortgage. And most of those dollars, if not all of those dollars, flow through their checking account, right? And you pay your bills from there. And if you build up some residual money in a checking account, a lot of customers keep it there and some move it to a savings account. Either way, these short-term deposit accounts see a lot of money, a high volume of money over time, but they pay us very little in return, right, for that loyalty. The biggest benefit of a checking account is just the secured access to our money. Well, what if that same secured access to money is available within your mortgage? But while you're not using your money, your mortgage principal balance is lower by the same amount of money you deposited. And what if that mortgage recomputed interest daily, right? Recomputed interest daily on that lower balance, right? Because your cash or idle money is sitting in there waiting to be spent on something else tomorrow, next week, next quarter, next year, saving you monthly and annual and total interest costs. That's how this loan works. So, to answer your question, Danielle, the biggest cause of interest expense is not the interest rate. It's actually the length of time you're in debt and how high or how low your principal balance is, where it's headed. Is it remaining high for a very long time, or is it headed down quickly? If it heads down quickly, you're going to pay less interest. Let me give you a quick example, a mathematical example. And this sounds extreme, I know, but let's just use a really high interest rate against a really low interest rate, okay, and compare the terms. If we were interested in saving time and money, and I had two choices, a 10% mortgage that paid me off in 5 years, or a 2.5% mortgage designed to pay me off in 30, that 10% mortgage is a significantly better deal. They'll save a ton of time and a ton of money, right? And when you save time and money, that creates opportunities. Opportunities to go buy another property, opportunities to pay for my kids' college education, fund, financial challenges as they arise here and there. There's a variety of things and maneuverability that you achieve because you avoid so much interest cost. And, reducing your rate isn't the exclusive way to do that. A more impactful way to do that is to attack your principal. And that's what makes this so special. It makes it easy.
Yeah. And actually, it just kind of like, I just realized when you said zero balance checking account in the beginning, I was trying to kind of figure out in my mind what that means. And I think in simple terms, when we're talking about a checking account combined with the all-in-one loan, what's essentially happening is anytime you deposit money into that checking account, and you can correct me if I'm wrong, but the money goes into the checking account, whether it's idle money that was sitting in another checking account and it's just sitting there, so why not put it into this account? Direct deposits coming in, maybe you flipped a property, you're putting money into this checking account. At the end of the day, that checking account sweeps, right? And it takes that money and puts it down on the principal balance of the loan.
That's exactly right. Yep. So if I owe $300,000 on my all-in-one loan right now, that balance is held by the HELOC, and I deposit, call it $5,000 today in my all-in-one loan checking account. They're linked together. They engage each other automatically. I don't have to lift a finger. There's no extra manual step to do anything. Today, that $5,000 deposit will automatically sweep. It's called a sweep. It's just a digital transfer where it sweeps the money from the checking account, and the checking account at midnight will show a zero balance. That's because that $5,000 deposit that I made earlier that day sweeps over to the HELOC and paying down the balance. It pays down the balance by $5,000. So I literally wake up the next morning, and instead of owing $300,000 on my home, I only owe $295,000 on my home. And it recomputed interest at midnight, right, the previous night. So if I spend $200 today on grocery shopping, my balance goes up by $200. But the bulk of my money sits idle, waiting to be spent. And I think this really kind of, brings us into highlighting, kind of the obvious, but I think it's so obvious we don't think about it on a daily basis as just consumers in general. Think about how we spend, or rather think about how we don't spend. Our bills and expenses aren't paid for on one single day each month, right? We don't go grocery shopping for the entire month on just one day. We do that weekly. Well, our utility bill isn't a weekly expense. It's a one-time monthly expense. Same thing with a cell phone bill. Your property taxes aren't necessarily due until, so maybe semi-annually. So we earn a lot of money along the way, and it sits idle waiting to be deployed for those expenses. And like most Americans, a lot of people have residual cash sitting in a checking account, because not many people, believe it or not many people live actually paycheck to paycheck and zero out their checking account balance every month. Most people that can qualify for a mortgage have residual money always sitting in their checking account or savings account. So all that money is put to work in the all-in-one loan.
Right. Yeah, no, that's, so then when you're going to make payments, let's say you're going grocery shopping, you're going to have a credit card, right? That's linked with the checking account.
Yeah.
You don't have to do anything to move money from your mortgage to the checking account then go grocery shopping. It's all combined together.
It's all automatic, no manual step. The all-in-one loan checking account features include everything that you would normally receive with a traditional checking account that's not a zero balance account tied to a mortgage. So ATM debit, Visa cards, check writing, online banking, mobile banking, bill pay. You could link external accounts to it, ACH, transfer money in between accounts, wire money internationally or domestically. Any transactional fees that are incurred are reimbursed, from third-party network providers. So if you go to an ATM machine, maybe at a 7-Eleven as an example, and that network provider for that ATM machine charges $5 to pull out 20, that $5 charge is actually reimbursed automatically back to the account. So it's a consumer-friendly, checking account that just happens to push your money to the mortgage side, allowing your money to work harder for you until you need it. So in effect, Danielle, it's kind of like you're literally investing your money into your home, right? Even if you need to spend it tomorrow or next week, today you're able to invest your money into your home, which protects it. It also shields your cash, right? It protects it because you're deploying it into an asset, which is your real estate, which is appreciating at the present moment. And while it's there, it's also serving to reduce your mortgage expense, your mortgage interest expense at the rate of the loan itself. So would you rather save, as an example, 3.75% in interest, or earn, 0% in your regular checking account?
Right.
It's sort of a no-brainer.
Exactly. So, we talked a little bit about the fixed, how interest is calculated. Can you explain in a little bit more detail, how is the interest calculated on this loan? People always ask me, well, what is my mortgage payment? And it's like, you don't really have a mortgage payment, right? Because the way that it is it's calculated daily. At the end of the day, it sweeps, right? Calculates interest. And then at the end of the month, it totals up those interest payments and takes that money out the following month, correct?
Yeah. The way to think about it is it's a simple interest loan. There is no amortization schedule, no predetermined interest cost. Your payment is never structured to where you have to pay a set amount of principal and interest. In fact, the principal repayment is and the interest payments are separate events. That's really they occur separately from each other, right? We're so used to sending away a singular monthly payment towards a debt. Again, a mortgage, a student loan, a boat loan, you name it. All loans in the United States are really structured this way. And the all-in-one loan changes that completely because it's a benefit to the consumer if we can separate them. Your deposits that you make into the all-in-one loan checking account, which is where you manage your bills and expenses from, automatically applies your money directly to principal, never interest, never. So this makes it the only truly principal paid first mortgage product in America. I want to repeat that. The all-in-one loan is the only principal paid first mortgage in America that I'm aware of today. Not even a traditional HELOC does that. Right. And then the interest is calculated nightly on the unpaid principal balance. So just to give you a quick example of the math, it's the interest rate times the unpaid principal balance at midnight divided by the number of days in the year. So 365 equals your daily interest cost. Right. And that occurs each night at midnight. Now that daily interest cost isn't charged to the account. It's not charged to the borrower each day. That charge is delayed. So it's just computing it nightly automatically. Right. So once the month ends, each day's interest is just totaled up. Right. So today, maybe my interest expense at midnight was $20.19. Maybe tomorrow after I make a deposit, it recomputes at $15.10, so on and so forth. So it does that each day throughout the month. And then at the end of the month, each day's interest is totaled up, and that becomes the interest payment, that total cumulative daily interest. And even then, Danielle, you don't have to lift a finger to even pay for that. The interest payment is drafted automatically from the line of credit, from the all-in-one loan line of credit on the 21st of the following month. And it's not only convenient, but it actually creates a compounded, savings benefit, because it's keeping even the money you're going to have to spend on interest in the HELOC for an additional 20 days prior to being drafted, right? So it allows you to continue to snowball the savings and reduce your balance dramatically faster without any, weird effort. You're not having to change your spending or change your lifestyle or make more money. It's doing it for you automatically.
Yeah, and I think, when I really think about the loan and all of the benefits that it has, and I tell people, like, this is not a loan for everybody, right? This is not a loan for somebody that lives paycheck to paycheck. It's just not going to be, a loan for that type of person. However, in my opinion, what's so great about it is, number one, you're able to save tens of thousands of dollars in interest over the life of the loan as compared to a traditional 30-year fixed. Even if you got into a 30-year fixed at a low 3%, interest rate, this product is still going to allow you to save that much more interest. The second huge benefit for me, and I'm in mortgage and real estate, so being in mortgage, well, especially in real estate, we flip properties, we do a lot of different like real estate investing and stuff like that. So we need liquid funds. So if we pay down, our mortgage balance and we have that equity, or maybe we even do a cash out refi, take the money out, we don't have to use that money right away, but it's available for us if we wanted to go buy a property, right?
Yeah, great.
So always
great point. Great point, because you're to go achieve that in the conventional mortgage world, you're almost rushed to make that decision based on the interest rate environment, right? Where if you're considering making another real estate purchase in the future, whether that's near term or later this year, you're kind of looking at you're being influenced by the interest rate environment today in order to rush into another refinance and take some cash out, even though you may not be ready to buy, right? You're not necessarily searching for the property yet. Maybe that's a July or August event. And so you're not out there actively searching, but you're kind of forced in a way to consider refinancing and incurring those costs and taking on a higher payment amount in that traditional mortgage if you were to do that right now, right? So in the all-in-one world, you don't have to do that. You refinance into it. And by the way, you mentioned low interest rates. Our typical customer is the one that is refinancing out of the historically low rate that they refinanced into just, a year ago, or even less in some cases. Truly, we are refinancing people out of their 2.5%, sometimes lower, traditional mortgage, where they have 29 years left on it, into the all-in-one loan. Yes, it has a higher rate. It's still very competitive, very low from a historical standpoint. But again, we're providing the customer complete control of their principal balance and their payoff trajectory and the use of their equity money, and much greater control of their interest expense. So the upside to the all-in-one loan is substantial, also because if they do that refinance right now, we can supply them access to equity above and beyond their principal balance, so they don't have to take that at closing.
Exactly.
Just keep that there and available for when they're ready, and they can just write a check right out of it or wire the money to escrow, and even make an all cash offer in a lot of cases and win a more competitive deal. So a variety of different, opportunities. And I think that's the biggest value. I keep repeating this, but it's the maneuverability, the optionality, high optionality. You don't get that with, especially out of the mortgage industry in terms of mortgage products. This allows you to customize the result based on what you want and your behavior.
Well, and the thing is, if you take money out on a cash out refi, let's just say, you want to cash out your equity, you take a cash out refi. Well, now you're paying interest on money that you may or may not need at this time. And then it's sitting idle in the checking account, which is
earning nothing. Yeah.
It's the complete opposite of what, the all-in-one loan is here for. And it's so funny because right now I hear so many people say to me, you know what, I think I just need to sell my house and buy something else, but I don't know where to go. And the reason why they want to sell their home is not because they don't like their home, it's because they want to cash out on the equity that they now have because prices have gone up so much. So with this particular product, what they can do is refinance into it, take out however much to just pay off their mortgage, have that equity there to be able to use for whenever it is that they want to use it, not have to pay interest on it, and essentially stay in their home, not just have to sell their home to take up, to get the money to be able to do something in the future. They can do it with the all-in-one loan.
Totally. And I know that you work with, real estate investors as well, Danielle. If you don't mind, I can touch on that. I think that it's a phenomenal program for those folks that are really building their wealth portfolio, their asset portfolio with additional real estate. And, this can be applied to not only primary residences and second homes, but also to investment properties. And it's a phenomenal way to manage that, that flow of income, rental income. Because, as a real estate investor and owner, I would think that you would want to achieve a couple things. Number one, I think that loyal renters that pay on time are very valuable, right? You don't want to scare them away. You'd like to have more of those, right? That rent your properties. Number two, you also want to grow your positive cash flow. You want to grow your monthly cash flow in that property. And, traditionally there's only a couple of different ways to be able to achieve that. That is, you either raise rents and scare away that loyal customer, right? You can't price yourself out of the market with your rental cost. And number two, the only other way is to refinance your mortgage again. But rates don't always cooperate. They're not cooperating right this moment on conventional mortgages. So you can't always lower your payment in order to grow your cash flow in that rental property. Well, the all-in-one loan, again, solves those issues. You don't have to continue to chase interest rates or even necessarily raise rates. Instead, you just flow your rental income directly into the mortgage, into the all-in-one, and that reduces your monthly expense automatically. So that grows the difference between what you're collecting in rents and what your interest obligation is each month automatically for you. So you're growing your positive cash flow, right? And that, and again, of course, you have an easier time stroking a check and buying another property. You're paying for a repair, if that comes up. So yeah, a lot of different benefits.
Huge. It's huge for real estate investors. How would you say, or what would be some of the reasons that financial advisors and real estate agents should really, really know and understand this product in order for them to better serve their customers?
Yeah, let me start with financial advisors. Fiduciaries in general, are folks that are really, they're really tasked with developing not just wealth, but also mitigating risk and helping their clients mitigate or reduce their unnecessary expense in their life, right? It's really a zero-sum game if you think about it. Each of us at the household level carries a balance sheet, right? We have a personal balance sheet. We have our liabilities and we have our assets. And there's only so much money to go around, right? We all wish we could just wave a magic wand and make more of it, but that's not always the case. Most people can't do that. Even if we work harder, it doesn't always equate into a larger paycheck, right? So how else can you fortify your financial security other than cutting back on your expenses and changing your lifestyle? It's very difficult. And even then, when you change your cell phone carrier from one to the other, you don't necessarily change the trajectory of your retirement security, right? You're not farming hundreds of thousands of dollars from changing your cell phone carrier or cutting back on cable a little bit, right? So what's the easiest and the biggest, most obvious place to really farm savings? It's your mortgage. And again, I don't mean to sound, sort of adverse as I look inward at our own industry, but it's the truth. Our industry really hasn't done a great job at innovating the mortgage and making it easier to pay down and save money and continue to invest in real estate. That's what the all-in-one loan does. So that savings that a financial advisor's client farms through the use of the all-in-one, not only gets them out of debt faster, but it creates, additional opportunities to develop the wealth side, the asset side of their balance sheet. So for a fiduciary, this speaks volumes. It's people can save money, reduce their mortgage expense and exposure to unnecessary costs while they remain liquid, which helps them also fortify the asset side and maybe be more aggressive. I'm not advocating the use of home equity dollars to invest with. What I'm advocating is sheltering your income from interest expense so that those dollars can then be deployed to grow your wealth with. Okay, there's a difference. Number two, for real estate professionals, if you think about it, they share the same problem that we do as mortgage professionals. Who needs help? How best can I serve them? And that's difficult. It's really difficult, I think, to stand out amongst your peers these days. I think as a consumer or a potential home buyer or home seller, and again, I don't mean to sound adverse or like I'm talking down to the industry, but I think as a consumer, it's tough to differentiate one professional from the other a lot of times. We sort of look like a big bowl of oranges. You can't tell one orange from the other. One orange may be sweeter than that one, but you don't know until you get into it.
Right.
So, it's fungible. So, how do you differentiate yourself? Well, I'm telling you, when real estate agents participate with the mortgage conversation and they talk up and they talk about the all-in-one loan as an option, right? It really piques curiosity. People are extremely interested in hearing more about reducing the total price tag of financed real estate versus just getting the same old ball and chain, mortgage that just gives them a payment. Let's change that ball and chain into a battle axe, if you will. And a realtor really benefits from that because they're helping their customer pay less in the end. And that also helps that customer buy again sooner, right? Which comes back to that real estate agent. So there's a variety of different ways that this helps. It helps showcase your knowledge, differentiates who you are as a professional, but it also puts your customers in a much better place financially.
Absolutely. Yeah, I think for, somebody going into the all-in-one, even if it's somebody that just wants to pay off their home sooner, save, tens of thousands of dollars in interest, have no change to their spending. I mean, I've done this, the simulator for several people where I compared a 30-year fixed and compared that with the all-in-one. I compared a 30-year fixed at 3.5, the all-in-one loan, and they were paying it off 4 and 5 years, where a traditional 30-year fixed, it's 30 years, right? So
look, I mean, and you mentioned it, Danielle, I don't mean to cut you off, but you're absolutely right. I get excited when you talk about the simulator, because that's key, right? The interactive simulator is really the tool that allows you to, with your customer, to compare a traditional mortgage to the all-in-one loan. Look, we don't do this loan unless it's offering a financial benefit, unless it's really truly going to help somebody get ahead. And, it's funny because oftentimes, I know you can relate to this, that sometimes when you're running the simulator and you're showing, and it's a full forecast that really is takes in a lot of logic that is can seem complex, but it's extremely easy to use and very realistic and conservative in the result. And I can touch on that comment here in a minute. But what's funny is sometimes when you see a result for somebody that, hey, you're going to, the all-in-one loan can get you paid off in 14.6 years, and you're going to save $82,000 in interest costs versus your traditional mortgage that you already have. It's sort of a letdown, right? Even that kind of result, sometimes you go, because you're expecting the 6-year payoff with $180,000 in interest savings, right? Yeah. It's funny, but that's where the rubber, meets the road, and you can test drive the financial benefit and collect just a minimal amount of information from your customer and run that simulation.
Right.
And do you want me to touch on where to find that, or as a resource that is available on our website? Yeah, on the website is allinOneLoan.com. And if you just scroll down on that homepage, you'll find the calculator there, and it's very easy to use. But
one of the things I say about the all-in-one simulator is what's very, very important is inputting the information correctly. So a lot of times what I'll do is I'll do that with the client. So that way I can ask the right questions, because if you're not accurately putting in like your net deposits, or you're not really sure about what that amount is, that can really change how much interest and how quickly you're able to pay that off. One thing I also wanted to point out in regards to, the traditional person just doing the all-in-one to pay off their home sooner, save all of this in interest, and then taking that real estate investor that, might be getting hard money loans right now at 10, 12% because they don't have the cash. to be able to buy, fix, flip other properties, or even buy and hold, this is a game changer for them because they're using the interest rate on the all-in-one loan to be able to go and buy more properties and also save so much more interest on those other properties as well. So it really is for so many different, types of people. There's so many different things that you can do with the all-in-one loan. I think it's an amazing product. I'm so happy that we have it to share with everybody. And I think that's really it. I mean, I don't know unless there was anything else I missed, I think that's really it.
Yeah, no, I think you covered it very well. Again, I think that everybody should know that it exists, as you indicated before. It may not be for everybody, but I certainly think that even those people that may not, be suitable for it today. And again, a suitable candidate is somebody that is cash flow positive, fairly disciplined with their finances, doesn't spend more than they make routinely. I know that occurs here and there. It can, right? We have kind of peaks and valleys over the course of a year in our expense level, but for the most part, if you're somebody who lives within your means and has some control over your spending and can qualify for a 30-year fixed mortgage today and know how to use a checking account, the chances are you'd benefit greatly from this product. You should minimally know that it exists. And that's really the overwhelming message. It's a sign of innovation in the industry. And I think it's a welcome one.
Absolutely. And I want to point out one thing. This just came to my mind real quick. Not that this would ever happen, but God forbid this did happen, right? So let's just say you take out the all-in-one loan and you have a line of credit for $500,000, but your balance is 300, for example. So you have $500,000 line, $300,000 is all you use, and God forbid you lose your job or you get sick and you're out of work for 4 or 5 months as you're trying to, to get a job, right? Because you have that $200,000 there, is it like you can go that many months in a traditional mortgage, you're going to be late on your mortgage payment, right? Because you can't make the monthly payments. But in this particular type of loan, you're not, because you have that equity there.
Yeah. You're dead on. You're 90 days away from defaulting, right? If you're not back up on your feet on a traditional mortgage and making those payments. Of course, there might be some modification or, sort of forbearance plan or help that a lender or a bank may help with, right? But still, there's no automatic kind of safety net built into a traditional mortgage. They're not designed to do that for people. The all-in-one loan it's the maneuverability you get over an extended period of time, 3 decades, that allow you to really, kind of flexibly get through those challenging times when they do occur. Because without question, the one thing that's consistent is that life is inconsistent, right? There's going to be another curveball that is thrown at us all, and each of us responds to or has to respond to that very differently than everybody else. But the all-in-one loan is a flexible credit facility that allows you to maneuver through those things without worrying about losing your home or going delinquent on your payment. In your example, you're absolutely right. You can, if you owe only $300,000, you have the $500,000 credit limit. Literally you could live for years off the line of credit. We have actually stories like that, Daniel, testimonials of people that have written into us through the financial crisis earlier last decade, right? Where people did lose their job. In fact, even during this COVID sort of crisis, there have been people that have lost their job or suffered income loss. And with the all-in-one loan, it's a safety net for them. It's the benefit of having that line of credit they can rely on and live off of until they get back on their feet without worrying about going delinquent or losing their job. They could do the interest payments automatic. And as long as there's credit available, that continues to be made automatically. You're never going late. It's extremely hard to go late on this loan, actually. So, and you kind of hit on a point by bringing this up. A lot of people ask us, Danielle, like, what's the catch? Why would a lender do this? Right? I mean, it's kind of an obvious question that I think maybe your audience would be interested in hearing the answer for. The reality is that if we make a traditional mortgage, the amount of loaded interest that comes with one of those is higher than we typically will earn, or our bank partners that support this loan with us will earn from a customer. However, a traditional loan typically pays off about every 5 years. It's about the runoff rate. About 5 years historically, mortgages are recycled. I would even argue that, given where rates have been, people have refinanced more frequently than 5 years into another mortgage for whatever reason. So even if we make a long-term mortgage, like a 30-year or a 15-year, the chances are people will lose that customer sooner rather than later, right? It'll happen pretty quickly. And that's costly. It presents a lot of risk. With the all-in-one loan, we just don't have that problem. Again, it solves that issue. It's a stickier loan product because you have this flexible credit facility. You can pay your balance down to zero and you don't have to close it. It doesn't close automatically. You can continue to borrow money when you need it in the future and pay it back down. Many of our customers actually have paid off their house several times using the same mortgage because they borrow from themselves and go renovate or go, travel. And then power it back down to zero again. So it just creates a stickier relationship, less risk as well, where that delinquency and default is less of a issue. In fact, we have no delinquencies, no reported delinquencies or defaults to date. So it's an enormous benefit for us as well.
It's their loan for life.
Yeah. It's only the last loan you might ever need on that property.
Exactly. Yeah. No, I love everything about the all-in-one. I really, really, really appreciate you being here and explaining a lot more about it. And I think it brings so much value to everybody. So if anybody's looking to get more information about the all-in-one loan, you can call me. My phone number is in this video. And I can also walk you through the simulator, as I mentioned before. You can go to aioloan.com. You can do the simulator there, but it's also important to make sure that you're inputting the right information, just so that all of the simulator actually, comes out accurate. But I'd be happy to talk to anybody about the all-in-one loan if you're a real estate agent or a financial advisor. I know Dave had mentioned before that he is more than willing to do a webinar for groups. So if you want to do one for your group, we would definitely be happy to get that set up. And I'd love to spread the word about the all-in-one loan. So I really appreciate it, Dave. Like I said, all my information is in the video, and I look forward to helping more people and getting them into this loan and bettering their life. So
my pleasure. Thank you, Danielle.